Hello and welcome to Nirmal Bang, ladies and gentlemen. I'm Hiral Dadia. We have with us Rahul Arora, CEO at Nirmal Bang Institutional Equities, joining in. Welcome to the show, Rahul, and a happy Diwali and a prosperous New Year to you and the team as well.
Thank you so much for having me, Hiral. Wish you the same and to all the viewers as well. A very happy and a very prosperous Diwali, and I hope to have a great year ahead, COVID behind.
Absolutely. Rahul, this is the time of the year that everyone's waiting with the kind of stock picks that brokerage houses actually come out with. And let's actually understand from you as well. From here on, firstly, in very short terms, what's the outlook that you have with the kind of new highs, few minor corrections that we've already seen so far?
So, Hiral, I think if investors are putting in money today, they need to have slightly calibrated expectations in terms of what the returns could be. From the peak of the pandemic, the Nifty, which was at 7,500, has returned you 18,500, and I think that's a phenomenal return by any stretch. If you've missed the party, there's no need to feel bad. The markets are always over a period of time going to head higher. There are going to be corrections. But I think if you're going to enter the market today thinking you're going to have the kind of returns that you have over the last 18 months, you might be disappointed. You will obviously beat the fixed deposit returns. I think the market could potentially still compound 10-15% from here on an aggregate basis. But don't expect the kind of euphoria that you saw over the last 18-19 months to replay itself over the next 18-19 months.
Right. So, with all of this said and done, which sectors do your top picks belong to? Where are you playing your bets?
So, that's an interesting question. I think, there are two ways of looking at this. One is that the economy is rebounding from a very prolonged lockdown, and some industries have suffered more than the others. So what has popularly been come to known as the open up trade, we're looking at those names with some amount of interest. They could be either retail plays, multiplex plays, hotels, and then, of course, there are the structural plays, which I think would have probably got more pronounced because of COVID. Take life insurance, for example. And the entire digitization of the economy that's taking place, not just in India, but globally, and who's best placed to sort of capitalize on that. So I think the two, sort of structural themes that we would play would probably be more of the opening up trade, which I think would probably still hold for the next 1.5 years. And I think slightly more structural in nature could be something like digitization and life insurance.
Right. So let's start off with, when we're talking of the opening side play, which sectors which are now opening up, especially on the consumption front as well. Which would your top pick be on that front, and what would your rationale be?
So I think, Hiral, if you take each of these sub-segments, right? So when you're talking about opening up, let's take each of them individually. So let's take hotels, right? And I think it's best to be with industry leaders. So in hotels, you would look at something like an Indian Hotels. Remember, at the peak of the cycle, their debt ratios in excess of 4x have come down by more than half. I think the occupancies are picking up in a very material way. The average room rentals have picked up in a very material way. And I think for a lot of these players, not only have they bounced back into EBITDA positive territory, but I think there's a good chance that in the third quarter, they'll bounce back into profitability at the bottom line as well. So I think, in any super cycle that you see for hotels, Hiral, I think these are companies that will probably give you high teens in terms of return on equity and return on capital employed. And for someone like an Indian Hotels, which is, I think, has tripled from the peak of the pandemic, I think it had dropped down to about 70 and change. And as we speak today, it's somewhere in the range of about 220, 210, 220 or thereabouts. I wouldn't be surprised if the stock inches up to close to about 300 even from here. The other industry, Hiral, surprisingly, which hasn't opened up at all and opens up at least in Bombay, in a big bang way around Diwali, is the multiplex sector. And you have Kumar's movie Suryavanshi releasing that weekend. I think it will be very interesting to see how that plays out because people are finding it comfortable to take, holidays within the country, go to hotels, go to restaurants. So we may actually be surprised to see the turnout at theaters as well. So I think Inox Leisure, I think if you compare it to PVR, the balance sheet, it looks a lot better. The promoter holding is good. I think the premiumization story for Inox pre-COVID through their Insignia brand had worked out pretty well. So they were able to increase their average ticket prices. And I think even on the advertising and food and beverages, they were operating at a reasonable discount to PVR, I would say. And I think there is a lot of room for that to be corrected, and it was work in progress before COVID hit. So, some would argue our numbers are slightly on the aggressive side, but I think given where we are on our projections 1 year forward, the stock's coming at south of 20 times or thereabouts for a consumption name. And I think the third high conviction idea here would be on the retail side, which would be Bata. We've just started resuming office over the last month or so. Schools are just about opening, colleges, events, social events, family gatherings, all of that is likely to be picking up. So the demand for closed footwear is going to come through in a very material way, I think. I think Relaxo, for example, has benefited from the lockdown because a lot of us were using open footwear, sandals or chappals or things like that. I think as the economy opens up and you start stepping out of your house, closed footwear comes back. And Bata is doing a lot of good things, not just with men's footwear, women's accessories, children's footwear, so on and so forth. Again, it's a multinational play. It has a change in management coming to it about 40, 42 times 1 year forward. Not the most expensive name in the world. So I think as open up themes, if I was playing three names, these would probably be on top of my list. Bata, Inox, Leisure, and I think they make a fairly good portfolio holdings.
Right. So, these are great names that you've given us, and it actually fixes really well with the way things are happening up. And it's a very logical move. It's a very logical way of thinking that you've put through these ideas. Another sector, Rahul, if you have to talk about, is in terms of where the auto space goes. Yes, a lot of private, transport is something which did pick up. However, do you see a trend changing now? Anything that looks interesting from the auto space?
So I think it's gone through its challenges, off late because of the semiconductor issue, and then of course because of COVID and the kind of labor availability and the shifts and the utilization levels that had dropped. But I think given where we are in the cycle in terms of having had good monsoons for the last couple of years, we are still fairly sanguine on the tractor side. So I think we would still look at buying into a name like Mahindra. I think the fact that they've chosen to get out of non-profitable businesses and focus on the return on capital employed has helped the stock re-rate in a fairly material way till now. My sense is it could still potentially compound at 15-20% even from here. And with the economy opening up, construction coming back, infrastructure projects coming back in a material way, I think the demand for commercial vehicles could also sustain. And anyone that has a good portfolio of buses and commercial vehicles, the point we were making about Bata and schools opening up, the demand for school buses and things like that will also come through along with public transport. So I think a good play, of commercial vehicles and buses could also be a good sort of extension of tractors. And I think something like an Ashok Leyland could be a beneficiary over there. Tata Motors has doubled, more than doubled because of the EV news. So I think there's still valuation comfort that Ashok Leyland has compared to Tata Motors. So I think that could be an interesting name. And a couple of other names I think that I would want to highlight. If you're playing the electrification theme, I think one of the best placed players in India to do that is Sona BLW Precision. The stock's done remarkably well. We actually initiated on the stock just about a month back, and it's gone berserk since our initiation. And we've had to actually do a 10-year DCF and discount the cash flows to present value to actually ascribe a price target to it. But I think it could potentially be good for 20%. I think in terms of returns, because we're expecting our sales, EBITDA, PAT growth to be anywhere in the range of 38 to 42%. The return ratios of this company are very strong. Management pedigree is good. And if you take a call that the electrification in the Indian auto industry, which is in low single digits today, probably heads to the mid to the high teens or maybe even early 20s over the next 4-5 years, this could potentially be a big beneficiary. And if you want to play a proxy to something like an Ashok Leyland, I would look at a Jamna Auto, which is a very large component supplier with, again, mid-20s return ratios coming to you in the low 20s in terms of price to earnings multiple. I think that could be a good proxy name to play to commercial vehicles as well.
Right. Moving away from this theme, if you have to go to the structural side of business, you mentioned insurance is a great theme to play. Again, what would your top pick be there?
So here we have a buy on all four life insurance companies. Our pecking order, I think, just given where valuations are, would probably be, I would say ICICI Pru Life and SBI Life, we would be reasonably indifferent towards right now. They would probably be at the top of the list. Followed by a Max Life and HDFC Life Insurance in that order. Like I said, HDFC Life Insurance is a fantastic business, doing very well, very strong franchise, but of course the valuations that it commands, it leaves a lot of comfort for the other three names. I think if you look at something like a Pru Life, ICICI Pru Life here, this was a company that used to have almost 80-85% of its business coming through ULIPs about 4 or 5 years back. they've brought that down to the mid 40s, and they're now starting to focus on the higher margin businesses, and they focus a lot on the distribution and their bank insurance tie-ups as well beyond ICICI Bank. I think for a company that's coming to at about 17 times return on embedded value, our price to embedded value where it comes at is about 2.7, 2.8, which is about a 35% discount to HDFC Life. And I think our own sense is that VNB margins, which is the value of the new business that an insurance company does, could inch up to 26, 27% in the next year or two. So I think if that happens, there is reasonable room for valuation reset on the way up as you're moving away from market-linked products to more traditional and high-value margin products. And like I said, the valuation comfort sits well for ICICI Prudential Life, and the valuation argument can be made for something like an SBI Life Insurance as well that just reported results a few days back and came out with an extremely strong set. Max Life is a pick that we have in the mid-cap space. Again, done phenomenally well. One of the best return ratios in the business, almost hitting 20% in terms of return on embedded value. It's again something that if you want to play a mid-cap insurance company, it's a portfolio hold for me. It's a bit of a no-brainer.
Right. So away from that, if you have to see on the digital India side of business, what is it that you would recommend?
So I think if you look at the IT companies in India and which of those are best positioned to be garnering market share from the increased spend on digitization all over the world, not just in India, but BFSI has been a very strong component of revenues for a lot of traditional IT companies in India. That's diversified over the years into travel, healthcare, hospitality, and telecom and other verticals. Our own sense is that just given where valuations are and capabilities stand in terms of the total contract value, a lot of these companies have won. The earnings growth will be very strong for companies like an HCL Technologies or a Tech Mahindra, or even in the mid-cap space, something like a Persistent Systems. We think that these companies can probably compound 15-20%. Persistent has gone berserk. I know the stock is giving you many X in terms of returns, not percentages. I think it's gone up some 3-4X, if I'm not mistaken, in the last 18-24 months. But I think a lot of these have withstood the test of time, shown very good digital capabilities, are sitting on very high order books and total contract values, which is giving us good revenue visibility of mid to high teens over the next 2 years. So I think if you benchmark them to industry leaders like TCS and Infosys, our sense is that if you invest in like Tech Mahindra, Persistent, and HCL Tech, you could still look at getting potentially 15 to 20% kind of valuation.
So there is a catch-up game there. And apart from the two stories that we've already spoken about, Rahul, any other recommendations that you have for the next for this Diwali?
Well, I think a theme that has probably just begun over the last 2 years, maybe more pronounced over the last 1 year, where valuations have far exceeded themselves in the short term, would be chemicals. I think if you're playing the China plus one story, it's a multi-year story, if not a decadal story. And I think if you look at names like Navin Fluorine, where there's a good CRAMS business, although the stock is currently at about 40x or north of that, our own business channel check suggests that once you hit $100 million in terms of CRAMS revenue, the multiplier effect from there is quite strong, and it's only going to aid the margin profile of the company. I think that's one name that we would be very bullish on, would be Navin Fluorine. And if you're ready to go down the market cap range in chemicals, Hiral, I would look at something like a Rosari Biotech or a Galaxy Surfactants or even a Fine Organics. I mean, these are all, like I said, if the China plus one story is here to stay, it doesn't get over just because the stock doubled or tripled in 1 year. These are businesses that are going to compound over the next 10, 15, 20 years. So I think that remains one part of the market that looks interesting. And I think the other part could be road infrastructure projects. I think the road and highways minister, Mr. Nitin Gadkari, has left no stone unturned in terms of awarding projects, and the NHAI has worked well in tandem. And I think if you look at that sector, if you look at names like PNC Infra or K&N Constructions, the balance sheets are good, the order book to bill ratios are anywhere up between 2.5 to 3.5 times. I think they could land up giving you good returns over the 1 year perspective.
Right. So these are a few of the stocks that we should be watching out for as well. Thank you, Rahul, so much for joining us on the show, giving us your top picks. And again, happy Diwali and a prosperous New Year to you, the team, and all the viewers that we have. Thank you so much.
Thank you so much, Hiral. Wish you your viewers the same.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.